216 they paid off. 31st December. So there. So on December 31st, made necessary adjustment at the year end. So their year ends on 31st of December. So customer paid them all year subscription. October 1st. So how many months they delivered the service? October, November, December. So among this, so you can divide it with 12. It means 200 per month subscription. So at the end of December 31st, 3 months from this 2400, you can 3 months eligible for that you have earned the sales. So what is the answer here? Liability decrease, unearned revenue decrease, and sales increase. Sales increase credit. So unearned revenue to revenue. This 600 coming from 3 months subscription. Florian, this is what we mean by year-end adjustment. So recall our adjustment entries. So we do exactly like this, right? So already we have done all this stuff. So that's why I told you this lecture is basically a recap. But since we are accounting for all the current liabilities, so we must go through this one. So this one we already did that.
So why you say unearned? So where does 600 come from?
600 coming from here. So customer paid in advance for the whole year, 2400. So 2400 divided by 12. Answer is 200.
Yeah,
1 month subscription is for 200. So this is December 31st. So he paid on October 1st. So 3 months services company had paid. So company can record for this December 31st, 2014. This sales gonna be 3 months, right? So how much sales company gonna record? 3 months sales. So this is coming from 600 here. Multiply by 3 months.
So you have nine months left, right?
Yeah,
And
9 months. 9 months still is unearned revenue. It's not. Okay. You cannot claim that this is our sales. All right, Kathleen, Ploy.
Understand.
Understand.
Good. How about you, Ali? Understand? Fabian, Wu Xiang.
Yep, it's clear.
Good. If you understand that, please answer this question. When a business receives cash from a customer before earning the revenue, they credit. So basically, what we are talking about here, you receive the sales money in advance. So entry would be, so in that entry, what is credited? So when you receive cash against unearned revenue, what is the entry? Cash to unearned revenue. So what is being credited?
Unearned revenue.
Yes, A.
Accounts receivable? Oh,
no.
sorry.
Unearned revenue, because account receivable is that these have to pay us and we delivered the goods. Right, Kathleen? But here, before earning the revenue, goods are not being transferred, ownership is not being transferred, but we receive cash in advance. Right, Kathleen?
Okay, I understand now.
So entry would be cash to unearned revenue. So unearned revenue is being credited. Answer is A. Now the last one is current portion of long-term debt. Current portion of long-term debt. It means This is that part from long-term liability that we have to pay this year. Also, we call this, other name is current maturity or current installment. So a long-term debt often paid in installments. So that yearly installments, we call this current portion of long-term debt. So these are current liabilities, not long-term liabilities, because this due in 1 year. So now the last one, which is, so we just talked about current liabilities with known amount, which is current liabilities. Like we talked about unearned revenue, we talked about accrued revenue, we talked about payroll liabilities, we talked about sales tax, right? We talked about current portion of long-term debt. So all these, the figures are known that you have to pay this much, right? Or you receive this much. But some liabilities that are contingent, in which the amount is not known, so that we call this contingent liability. So these liabilities are not shown on the balance sheet, rather they must be disclosed. That's it. So you do not write it on the balance sheet. You write it on the notes of the balance sheet. Okay, this year we expect that, or it is expected that there is a law against us, and if there is a case against us pending, and what if the other party wins, so we have to pay this much amount to the other party. This is just a note. So I have a illustration here, so let's read that one. So Black & Decker, which manufactures power tools, they made a sales of 100,000 subject to product warranties. The sales is 100,000. So question is silent, so it must be the credit sales, right? Which is the account receivable through sales. Assume that in past year between 2% to 4% of products proved defective. It means 2 to 4% products, they are defective and customer applied warranty expenses. So they estimated that 3% of the sales going to be requiring warranty services or replacement charges. So the warranty expense going to be, expense didn't happen. Remember that one. They estimated in advance. Did actually 3% they pay from their pocket? No. Entry would be warranty expense to expense, warranty expense payable. They estimated, customer didn't, if customer claimed, then it would be warranty expense to cash or something whatsoever. But since it is not, so we create liability. 3% will be asking from us that your product is defective and the worth of $3,000. So that's why we create liability. So this 3,000 will go to, in advance, will go to income statement, and we kept some liability in our balance sheet. If something happened, we decrease the liability according to our cash, so that our expense recognition principles may not be disturbed. So this expense already went to the income statement, right? Now what happened? Assume that all the defects add up to 2,800, right? And we created estimated liability for warranty 3,000. Now claims are of $2,800. So simple, estimated warranty, and since we replaced that product, we didn't pay them the cash. Inventory decrease. Inventory decrease means credit, and liability decrease means debit. So our payable warranty liability going to be looking like this. So we created liability with 3,000. This actually happens. 200 is the balance, and we decrease our liability against inventory. We replace that one, so inventory decrease. If we pay them the cash, then it's going to be a cash here. Right, David, Sipade, Min, Aroni, Misha, Jordan?
Yes.
I just have a question. It's not really related. When we account for inventory, do we use the sales price or do we use the production price?
The production price, not the sales price. Misha, because whenever there is inventory, there's going to be a cost of goods sold, which means the cost price is going to be, not the sale price. Right, Misha?
Okay. Mhm.
Okay. So how we are going to record it? If the probability chances are high, we record it. If reasonably possible that we may lose or may not lose, then we just disclose it on the notes of the balance sheet. If chances are remote, then we ignore that one. Right? So we also record it. If chances are there, we record it and also disclose it. So sorry guys, I just missed one point. That, for example, in this case, the chances are 3%. We also record it on balance sheet and also we write it down on disclosure as a notes that we estimated 3% of warranty charge is going to be there, and we record it on the balance sheet as well. Okay, so what is the concept checker if you understand the contingent liability? So which of the following is not true about a contingent liability? Not true. We just discussed that. So number A, depends on future outcome of the past expenses. This is true. Yes. Must be recorded if it is remote.
B, right? If
Yeah.
it's remote, it's not true.
Right? Must be disclosed if it is reasonably possible. Yes. So answer is B. Well done. Okay, that was our treatment of current liability. If you have any question, please do ask. If not, then we may end our discussion here. So up till now, we have covered the current liability. The next lecture is going to be the treatment of long-term liability. And over there, we'll talk about the bonds, structures, and long-term debts. Okay, so no more question?
Sir,
One
when is
little
the
question.
final?
Okay, we'll talk about after this lecture discussion. So with this lecture, any question?
I have one small question. What is an example of contingent liability? Real life example.
For example, we sued our customer for disturbing us. This can be, or maybe we win or we may lose, or we sue our competitors that they use our logo illegally, or they just a little bit modified our logo so that customers are confused that it is our product or their product, and now the case is pending in the courts. We may win or we may not win, because so that's why we don't know.
Okay. Thank you, sir.
Right? Okay, any other question?
I don't have questions.
Okay, so I'm going to be stopping the recording. Okay, class, that is the end of our lecture. So stay safe, take care, bye-bye.